Hey everyone, Jordy here with another episode of Retire on Dividends. Welcome back to all my returning listeners, and a warm welcome to anyone joining us for the first time. If you missed our previous episodes, we talked about the major changes to SCHD in episode 1, and in episode 2, we explored how Jack Bogle's investment philosophy can complement dividend investing. Today, I want to dive into something that's been generating a lot of buzz lately, Bitcoin and how it might fit into a dividend-focused portfolio. Now, I know what some of you might be thinking. Jordy, what does a volatile digital asset have to do with steady dividend investing? Well, that's exactly what we're going to explore today. You know, when I first started my investing journey, I was strictly a dividend guy. I loved the predictability, the passive income, and watching those dividend payments grow year after year. Bitcoin seemed like the complete opposite of everything I believed in: volatile, speculative, no income generation. But over the years, I've learned that sometimes the best portfolio additions are the ones that initially seem to challenge our core investment philosophy. So let's talk about what's happening with Bitcoin. As of early 2025, Bitcoin has experienced remarkable growth, recently trading around $85,000 to $100,000, with some periods seeing all-time highs above $100,000. This represents incredible growth from just a few years ago. What's driving this surge? Several factors. First, we had the Bitcoin halving in April 2024, which reduced the new supply of Bitcoin. Then there was the approval of spot Bitcoin ETFs in January 2024, which made it much easier for institutional investors to gain exposure. And most recently, we've seen increasing corporate adoption and favorable political developments. But let me be clear, I'm not suggesting you dump your dividend stocks and go all in on Bitcoin. Far from it. What I'm suggesting is that Bitcoin might deserve a small allocation in a well-diversified dividend portfolio for reasons I'll explain shortly. One of the most interesting developments for dividend investors is the emergence of Bitcoin-related ETFs that actually provide income. Yes, you heard that right. There are now ways to gain Bitcoin exposure while still generating income. For example, some Bitcoin futures, ETFs, like Pro Shares, Bitcoin Strategy, ETF, BYTO, and Valkyrie Bitcoin, and Ether Strategy ETF, BTF, have been paying significant distributions to shareholders. These funds generate income through their futures trading strategies and pass some of that on to investors. There are also specialized Bitcoin income ETFs like the NEOS Bitcoin High Income ETF, BTCI, that use option strategies to generate income from Bitcoin's volatility. The concept is fascinating, essentially turning Bitcoin's famous volatility into an income stream. Now, there's a critical distinction to understand here. Most spot Bitcoin ETFs like BlackRock's iShares Bitcoin Trust or Fidelity's Wise Origin Bitcoin Fund don't pay dividends because Bitcoin itself doesn't generate income. The income-producing Bitcoin ETFs typically use futures contracts or option strategies to create yield. So why would a dividend investor even consider Bitcoin? Let me share 3 compelling reasons. First, portfolio diversification. Bitcoin has historically shown low correlation with traditional assets like stocks and bonds. When the stock market zigged, Bitcoin sometimes zagged. This diversification benefit can potentially reduce overall portfolio volatility, which is something we dividend investors should appreciate. Second, Bitcoin serves as a potential hedge against currency debasement and inflation. As central banks around the world continue to expand the money supply, Bitcoin's fixed supply of 21 million coins stands in stark contrast. Think of it as digital gold with some additional utility features. Third, the risk-adjusted growth potential is substantial. Even a small allocation to Bitcoin that performs well can meaningfully enhance your overall returns, potentially accelerating your dividend snowball effect. The funds you eventually generate from Bitcoin growth could be reinvested into your core dividend holdings. Now, I'm not suggesting everyone should rush out and put 20% of their portfolio into Bitcoin. Far from it. I personally view Bitcoin more as a satellite position, perhaps 1% to 5% of a portfolio for most dividend investors, depending on your risk tolerance, time horizon, and understanding of the asset. Remember, Bitcoin is still a volatile asset. In late 2024, we saw Bitcoin drop from around $99,000 to the low $80,000 in a matter of weeks. These kinds of swings are normal for Bitcoin, but would give most dividend investors heart palpitations if it was a large part of their portfolio. The key is position sizing appropriate to your risk tolerance. Start small, perhaps with just 1% of your portfolio, and only consider increasing that allocation as your understanding and conviction grow. Let's talk about practical ways to add Bitcoin to your dividend portfolio. The simplest approach is through spot Bitcoin ETFs like IBIT, FBTC, or BITB. These directly track the price of Bitcoin and are easy to add to any brokerage account. They're very liquid and have reasonable expense ratios, typically around 0.2% to 0.3%. For those seeking income, the Bitcoin futures ETFs or options-based ETFs I mentioned earlier might be worth exploring. Funds like BITO, BTF, or BTCI aim to provide Bitcoin exposure while also generating income. Another approach is allocating to companies that hold Bitcoin on their balance sheet, like MicroStrategy. These companies give you indirect Bitcoin exposure plus potential dividends, though MicroStrategy specifically doesn't currently pay a dividend. Finally, for the more technologically adventurous, you could directly purchase Bitcoin through exchanges like Coinbase or Binance and hold it in a secure wallet. This approach requires more technical knowledge but eliminates the ETF management fees. It's crucial to acknowledge the risks. Bitcoin remains volatile, could face regulatory challenges, and doesn't have the long track record of traditional assets. That's why position sizing is so important. I also recommend a strategy I call taking your original capital off the table. If your Bitcoin position doubles, consider selling half to recoup your initial investment. This way, you're playing with house money and can more comfortably ride out the volatility. Dollar cost averaging is another excellent approach for Bitcoin. Rather than making one large purchase, spreading your investment over time can help reduce the impact of volatility on your entry point. What fascinates me about combining Bitcoin with dividend investing is how they both embody long-term thinking, just in different ways. Dividend investing is about steadily building income streams over decades, focusing on companies that consistently return capital to shareholders. Bitcoin investing, at its philosophical core, is about preserving purchasing power over the long term through a scarce digital asset. Both strategies discourage short-term trading and encourage a patient, long-term perspective. Both can also benefit tremendously from compounding, whether that's through reinvested dividends or Bitcoin's potential price appreciation over time. As with all investment decisions, there's no one-size-fits-all approach. Your optimal Bitcoin allocation depends on your financial situation, goals, risk tolerance, and even your personal views on the future of money and technology. Some of you might decide that Bitcoin has no place in your dividend portfolio, and that's a perfectly valid conclusion. Others might find that a small Bitcoin position complements their dividend strategy nicely. The key is making an informed decision rather than dismissing the idea outright or jumping in blindly. So to summarize today's episode on adding Bitcoin to your dividend portfolio, Bitcoin has matured as an asset class with institutional adoption and regulated investment vehicles making it more accessible than ever. Some Bitcoin-related ETFs now offer income opportunities through futures or options strategies. Bitcoin can potentially provide diversification benefits, inflation protection, and growth opportunities for dividend portfolios. Position sizing is crucial. Most dividend investors should consider Bitcoin as a small satellite position. Implementation options include spot ETFs, futures, options ETFs, Bitcoin holding companies, or direct ownership. Risk management strategies like dollar cost averaging and taking capital off the table can help manage Bitcoin's volatility. Both Bitcoin and dividend investing encourage long-term thinking and can benefit from compounding. Remember, investing is a personal journey. My goal isn't to convince you that Bitcoin belongs in your portfolio, but rather to provide the information you need to make that decision for yourself. Before I wrap up, I'd love to hear from you. Are you considering adding Bitcoin to your dividend portfolio? If you already have, what allocation have you chosen and through which investment vehicles? Drop your thoughts in the comments below. And if you found this episode helpful, please hit that like button and subscribe to the channel for more dividend investing content. It really helps the channel grow and allows me to continue sharing these insights with more investors. Until next time, this is Jordy with Retire on Dividends. Happy investing, everyone.